Imagine it's October 1929. You're Harold Whitmore, 58 years old, standing on the front porch of a modest two-story home in Cleveland, Ohio. You've worked at the National Carbon Company for 31 years, started on the factory floor, worked your way up to floor supervisor, never missed a day, never complained, played by every rule, and now, finally, you can see the finish line. You have a company pension waiting for you. You have $4,200 in savings at Guardian Trust Company, the same bank your father used. You own shares in U.S. Steel and General Electric, purchased carefully over 15 years through your broker at a respected Cleveland brokerage. You have a life insurance policy with a cash value of $1,800, enough to cover your wife if anything happens. You've done everything right. The newspapers call it the Roaring Twenties. The economy is expanding. Your employer is profitable. Your bank has a marble lobby and armed guards. Your broker drives a Packard. 2 years from now, you plan to retire. You'll collect your pension, draw from your savings, live modestly off dividends. You stand on that porch, coffee in hand, watching the leaves turn. You have no idea that within 36 months, every single pillar you've built your retirement on will collapse. Everyone. Not because you did something wrong, because the systems you trusted were never as solid as they appeared. The company pension will vanish when National Carbon merges and restructures. The bank will fail in 1931. Your stocks will lose 89% of their value. Your life insurance policy will be cashed out early just to pay for groceries. And by 1933, at 62 years old, you'll be looking for work. This isn't a tragedy of bad luck. This is a pattern. And once you see it, you can't unsee it. What most people don't understand about retirement is this. It has never been about how much you save. It has always been about what your savings depend on. Every retirement plan in history has been a wager. A bet that the institutions, currencies, and systems you've entrusted with your future will still be standing when you need them. During the Great Depression, 5 of the most trusted retirement mechanisms in American history collapsed simultaneously. Not because people made foolish choices, because the mechanisms themselves contained structural flaws that only became visible under stress. This isn't a theory, this is documented history. The bank accounts, the company pensions, the stock portfolios, the real estate holdings, life insurance policies, all of them failed, not randomly but predictably, once you understand how each one actually worked. Today, we're going to perform an autopsy. Not on the Depression itself, on the retirement systems that died inside it. Because the lesson isn't that 1929 was unique. The lesson is that the same structural fragilities exist today, renamed, repackaged, and almost entirely unexamined. 1. The bank account. Let's start with the most basic retirement vehicle of the era, the savings account. In the 1920s, Americans trusted banks with their life savings the way people today trust index funds. It felt safe. It felt permanent. You walked into a building with columns and brass fixtures. You handed over your money, and you received a passbook with numbers printed in it. Those numbers represented a promise. But here's what most depositors didn't understand. When you deposited money into a bank in 1928, the bank did not put that money in a vault and waited for you to return. The bank lent that money out immediately at a ratio of roughly 10 to 1. For every dollar you deposited, the bank might lend out $9 or $10 to businesses, homebuyers, stock speculators, and other borrowers. This is called fractional reserve banking. It works perfectly well until it doesn't. The system depends on one assumption, that depositors will not all ask for their money at the same time. Between 1930 and 1933, that assumption collapsed. More than 9,000 American banks failed. 9,000, not 9,000 businesses, 9,000 banks. In 1930 alone, we had 352 banks closed their doors. In 1931, another 2,294. In 1933, nearly 4,000 more. And when a bank failed, there was no deposit insurance. None. The Federal Deposit Insurance Corporation didn't exist until 1934, after the damage was done. If your bank failed, your savings were gone. Not reduced, not delayed, gone. An estimated $1.3 billion in deposits were lost between 1930 and 1933. That's roughly $25 billion in today's money. But the number doesn't capture the reality. These weren't abstract losses. These were life savings, retirement funds, emergency reserves built over decades. Harold Whitmore's $40,200 at Guardian Trust Company? Guardian Trust closed in 1931. He received 11 cents on the dollar after years of liquidation proceedings. This is where people usually say, well, that was before FDIC. It couldn't happen today. And yes, deposit insurance has changed the game. But the lesson isn't about insurance. The lesson is about dependency. Harold didn't understand what his money actually depended on. He thought it depended on the bank. But the bank depended on its borrowers. Its borrowers depended on the economy. The economy depended on credit markets. And credit markets depended on confidence. When confidence broke, everything underneath it broke too. Every retirement saver today should be able to answer one question about every asset they own. What does this actually depend on? If you can't answer that question, you don't understand your retirement plan. You're just holding a passbook with numbers in it. 2, the company pension. Now let's examine the second pillar, the company pension. In the 1920s, company pensions were considered the gold standard of retirement security. They weren't as widespread as they would become after World War II, but for workers at large industrial firms, railroads, steel companies, utilities, a company pension was the ultimate reward for a lifetime of loyalty. You worked for 30 years, you retired, the company paid you a monthly check until you died. It felt ironclad. But here's what most workers didn't understand. A company pension is not a legal obligation in the way a debt is. It's a promise. And promises can be broken when the entity making them ceases to exist, or simply decides the promise is too expensive to keep. During the Great Depression, hundreds of companies either went bankrupt or restructured so aggressively that their pension obligations were reduced or eliminated entirely. Let's look at the railroads. In 1929, the railroad industry employed over 1.6 million workers. It was the backbone of American transportation. Many railroads had pension systems dating back to the 1880s. By 1932, railroad revenues had collapsed by nearly 50%. Companies began slashing costs. Pension reserves, which had never been legally segregated from company assets, were raided to cover operating expenses. Workers who had been promised $50 a month in retirement suddenly received $20, or nothing. The New York, New Haven, and Hartford Railroad, one of the great Northeastern lines, entered receivership in 1935. Its pension plan collapsed entirely. Retirees who had worked for that company for 40 years found themselves with no income and no legal recourse. This wasn't fraud. It was structured. The pensions were funded on a pay-as-you-go basis, which means current workers paid for current retirees. When revenues fell and layoffs began, the funding mechanism collapsed. There was no external guarantee, no pension insurance, no legal requirement to keep promises made to workers who had already retired. Now, you might say, that was before ERISA, before the Pension Benefit Guaranty Corporation. Things are different now. And yes, regulations have changed, but the structural lesson remains. A pension is only as secure as the entity behind it, and entities fail. Detroit's municipal pension system was cut during its 2013 bankruptcy. Several multi-employer pension plans are currently underfunded by hundreds of billions of dollars. The mechanism has evolved. The dependency has not. Harold Whitmore's pension at National Carbon Company? National Carbon was absorbed into Union Carbide during a merger and consolidation. The original pension plan was restructured. Workers who hadn't yet retired saw their benefits recalculated under new terms. Workers who had recently retired saw their payments reduced by half. Harold never collected a full check. That's the trap. You spend 30 years earning something that exists only as long as the institution behind it chooses, or is able to honor it. 3. The stock portfolio. Now we come to the most famous failure of the era, stock market retirement savings. In the late 1920s, millions of Americans began investing in the stock market for the first time. It wasn't just the wealthy, it was clerks, dentists, teachers, factory supervisors. The market had risen almost continuously since 1921. By 1929, the Dow Jones Industrial Average had increased nearly sixfold. People bought stocks for the same reason people today buy index funds, because they believed that over the long term, prices always go up. And they weren't entirely wrong, if you define long term correctly. But here's the part that's almost never discussed. Between September 1929 and July 1932, the Dow Jones Industrial Average fell from 381 to 41. That's an 89% decline. Not 50%, not 70%, 89%. If you had $10,000 in the market at the peak, you had $1,100 at the bottom. And here's the critical detail. The market didn't recover to its 1929 high until 1954. Think about what that means. If you were 55 years old in 1929 and planned to retire at 65, you would need to wait until you were 80 years old to see your portfolio return to its original value. Most people didn't wait. They couldn't wait. They sold at the bottom, not because they panicked, but because they needed to eat. That's the second trap of stock-based retirement. The math only works if you don't need the money during the drawdown, but retirement is precisely the moment when you need the money. It's non-negotiable. You can't delay retirement the way you can delay a vacation. And it wasn't just the decline, it was the fraud. During the 1920s, stock manipulation was legal. Pools of investors would coordinate to drive up prices, then sell to retail buyers at the top. Brokers pushed customers into stocks that paid the highest commissions, not the soundest investments. Financial disclosure was minimal. Earnings could be fabricated, assets could be invented. The investor protections we take for granted today, the SEC, FINRA, audited financial statements, none of them existed. So when the crash came, people didn't just lose money to a falling market. They lost money to companies that never should have been public in the first place, to brokerages that lent them money to buy stocks and then liquidated their accounts when prices fell, to a system that treated retail investors as fuel for speculation, not participants in capitalism. Harold Whitmore's shares in U.S. Steel and General Electric. Both companies survived, but his broker didn't. The brokerage collapsed in 1931. Harold's shares were held in street name, meaning the brokerage held them on his behalf. When the firm went under, the shares were tied up in bankruptcy proceedings for years. By the time they were released, Harold had already cashed out what remained to pay for medical bills. That's the pattern. Retirement assets exist on paper, but access to those assets depends on intermediaries, brokerages, custodians, clearing firms. If the intermediary fails, the paper means nothing. 4. The real estate investment. Real estate is often considered the safest retirement asset. You can see it. You can touch it. It doesn't vanish when a CEO commits fraud or a bank fails. In the 1920s, this belief drove a real estate boom unlike anything America had seen before. Florida land prices tripled. Suburban development spread outside every major city. Farmland prices surged as mechanized agriculture promised endless profits. People bought property as their retirement asset. They assumed that land, unlike stocks, could never go to zero. They were right. Land can't go to zero. But it can become illiquid. It can become unrentable. It can become unsellable at any price that makes financial sense. And that's exactly what happened. Between 1929 and 1933, U.S. farmland prices fell by roughly 50%. Residential real estate in major cities fell by 30 to 40%. Commercial property fell even further in some areas. But the price decline wasn't the real problem. The real problem was the collapse of the rental market and the impossibility of sale. If you owned an apartment building in 1930 and your tenants lost their jobs, you couldn't collect rent. If you couldn't collect rent, you couldn't pay your mortgage. If you couldn't pay your mortgage, the bank foreclosed. More than 150,000 homeowners lost their properties to foreclosure in 1933 alone. And here's the trap within the trap. Many real estate investors in the 1920s had borrowed to buy property. They had mortgages. When property values fell and rents collapsed, they found themselves underwater, owing more than the property was worth, with no income to cover the payments. Some tried to sell, but there were no buyers. Banks weren't lending. Credit was frozen. The few buyers who existed offered pennies on the dollar. So properties sat, rotted, became liabilities instead of assets. A retirement built on real estate only works if two conditions hold. The property generates income, and the property can be sold when needed. During the Depression, neither condition held. Real estate became a trap, not an escape. This is why sophisticated investors distinguish between owning an asset and having liquidity. An asset on paper means nothing if you cannot convert it to cash when you need it. Harold Whitmore didn't own rental property, but his brother-in-law did. His brother-in-law owned a small apartment building in Akron, purchased in 1926 with a 5-year balloon mortgage. In 1931, when the balloon came due, he couldn't refinance. The bank wouldn't lend. He couldn't sell because there were no buyers. He lost the building. And then, because he had personally guaranteed the mortgage, he lost everything else trying to cover the deficiency. Real estate didn't protect him. It destroyed him. 5. The life insurance policy. Finally, we come to the retirement vehicle that almost no one talks about, life insurance. In the 1920s and 1930s, whole life insurance was one of the most popular savings vehicles in America. It wasn't just death protection, it was a savings account with a guaranteed cash value. You paid premiums. The insurance company invested those premiums. And over time, you accumulated a cash value that you could borrow against or cash out if needed. For millions of Americans, life insurance was their retirement plan. They intended to stop paying premiums at 65, cash out the policy, and live off the proceeds. In theory, it was conservative, safe, guaranteed. In practice, it contained a fatal flaw. Life insurance companies invested heavily in bonds and mortgages, the same assets that collapsed during the Depression. When those assets failed, insurance companies came under enormous strain. Some failed outright. Others slashed dividends and reduced policy values. But the bigger problem was human behavior. When people lost their jobs, they couldn't pay premiums. When they couldn't pay premiums, policies lapsed. And when people ran out of money entirely, they cashed out their life insurance, often at massive losses, just to survive. Between 1929 and 1933, life insurance policy surrenders increased by over 300%. Policies that had been accumulating value for 20 years were cashed out for a fraction of their worth, simply because the policyholder needed money to pay rent or buy food. This is the irreversible constraint. Retirement assets only work if you don't need them before retirement. But emergencies don't respect timelines. If you lose your job at 55 and your only liquid asset is your life insurance policy, you will cash it out. You will sacrifice 20 years of accumulated value because the alternative is homelessness. This is what Harold Whitmore did. His life insurance policy with Metropolitan Life had a cash value of $1,800 in 1929. It was supposed to be a cushion for his wife after his death. By 1933, Harold had cashed out the entire policy, not because he wanted to, but because there was nothing else left. His bank had failed, his pension had evaporated, his stocks were worthless, his savings were gone. Life insurance was the last domino, and once it fell, Harold was 62 years old with no income, no savings, and no prospects. He spent the next 4 years working as a night watchman at a warehouse. He never retired. Now let's step back and examine the hidden mechanism. 5 different retirement plans, bank accounts, company pensions, stocks, real estate, life insurance, 5 different structures, 5 different institutions, 5 different promises, and all 5 collapsed at the same time. Why? Because they all depended on the same underlying system. All 5 required a functioning credit market. All 5 required stable employment. All 5 required institutional solvency. All 5 required liquidity, the ability to convert assets to cash when needed. When the broader economic system seized up, every retirement vehicle that depended on that system seized up too. This is the lesson that almost no one learns. Diversification across asset classes does not protect you from systemic collapse. If your bank, your pension, your stocks, your real estate, and your insurance all depend on the same economic system, then owning all 5 doesn't diversify your risk. It concentrates your risk with the illusion of diversification. This is what Harold Whitmore didn't understand. He thought he was diversified. He had multiple retirement pillars. He had followed the conventional wisdom of his era, but all his pillars were standing on the same foundation. And when that foundation cracked, everything standing on it came down. Now we come to the uncomfortable question. Who benefited from this collapse? Because in every financial disaster, someone is on the other side of the trade. During the Great Depression, several groups emerged richer than before. First, creditors who held cash. When asset prices collapsed, those who held cash could buy assets at distressed prices. Farmland that sold for $100 an acre in 1929 could be purchased for $30 an acre in 1933. The families who entered the Depression with liquidity, without debt, without obligations, emerged with more property, more businesses, and more wealth than before. This is why cash is sometimes called optionality. It's not the best performing asset in good times, but in a crisis, it's the only asset that buys everything else at a discount. Second, certain financial institutions that survived. When 9,000 banks failed, the banks that survived absorbed their customers, their assets, and their market share. Consolidation during the Depression created the foundation for the large banking conglomerates that dominate American finance today. Third, those with political connections. Certain companies received preferential treatment during the New Deal era. Certain contractors won government work programs. Certain banks received early access to the Reconstruction Finance Corporation's lending facilities. As always, proximity to power was the ultimate hedge. But here's what matters. None of the people who benefited were ordinary retirement savers. The beneficiaries were those who either had liquidity, had insider access, or had the scale to survive where smaller players couldn't. The retirement savers, the Harold Whitmores of the world, were on the wrong side of every trade. They provided the liquidity when they panic sold. They provided the cheap labor when they went back to work. They provided the distressed assets when they couldn't pay their mortgages. This isn't an accusation, it's a description. In every systemic failure, the cost is borne by those at the bottom of the information hierarchy, those who don't understand what their assets actually depend on. Now let's address the structural inevitability. Could the system have been saved? Could the retirement losses have been prevented? The answer is complicated. Once the credit system contracted, the cascade was mathematically inevitable. Here's why. Banks operate on fractional reserves. When depositors withdraw money, banks must call in loans. When loans are called in, borrowers must sell assets. When assets are sold, prices fall. When prices fall, more loans default. When loans default, banks become insolvent. When banks become insolvent, more depositors withdraw money. This is a deflationary spiral, and once it begins, it feeds itself. The Federal Reserve could have intervened more aggressively. It could have flooded the system with liquidity in 1930 and 1931. Some economists, notably Milton Friedman and Anna Schwartz, have argued that the Depression was made catastrophically worse by the Fed's failure to act. But even if the Fed had acted, the underlying vulnerabilities would have remained. The system was built on leverage. The system was built on confidence. The system was built on promises that assumed permanent growth. When growth stopped, the promises couldn't be kept. This is the irreversible constraint. You cannot promise everyone a comfortable retirement if the economic system underlying those promises can contract. But no system in history has grown without interruption forever. So every retirement promise, every pension, every savings account, every stock portfolio carries within it an implicit gamble that the system will remain intact long enough for you to collect. During the Great Depression, that gamble failed for an entire generation. And the systems we have today are not fundamentally different. They are larger, they are more regulated, they have more safety nets, but they still depend on growth, they still depend on credit, they still depend on confidence. And confidence, as history has shown, can disappear overnight. This isn't ancient history. The retirement plans of the 1920s failed because they depended on systems that most people didn't understand. Today's retirement plans are more complex, but the dependencies are similar. 401k plans depend on stock markets. Pension plans depend on bond yields and institutional solvency. Social Security depends on demographics and political will. Real estate retirement strategies depend on property markets and rental income. Annuities depend on insurance company solvency and interest rates. Each of these systems can work, has worked, may continue to work, but none of them are guaranteed. And more importantly, most people who depend on them cannot accurately describe what they actually depend on. Ask someone with a 401k. What would have to happen for your retirement plan to fail? Most people cannot answer that question, and that ignorance is itself a risk. Harold Whitmore couldn't answer that question in 1929. He didn't know his bank could fail. He didn't know his pension was unfunded. He didn't know his stocks were held by an unstable brokerage. He didn't know his life insurance would become his emergency fund. He didn't understand the dependencies. And by the time he understood them, it was too late to act. Here is the pattern. Every retirement system in history has promised something it could not guarantee. Roman soldiers were promised land grants upon retirement. The empire's collapse made those promises worthless. British investors in the 1700s trusted the South Sea Company. When it collapsed, so did their retirement savings. French savers trusted the assignat. Hyperinflation destroyed it. German savers trusted the mark. Same result. American savers in the 1920s trusted banks, pensions, stocks, real estate, and insurance. All five failed simultaneously. The pattern is not that these systems are inherently bad. The pattern is that they are inherently conditional. They work until they don't. And the transition from working to not working is usually faster than anyone expects. So what's the lesson? It's not that you should avoid retirement planning. It's that you should understand what you're actually planning for. Retirement security is not a product. It's not a number. It's not a portfolio allocation. It's an understanding of dependencies. It's knowing what your assets actually depend on. What institutions, what systems, what assumptions must remain true for your plan to work. It's having a plan for when those assumptions break, because history suggests they eventually will. Harold Whitmore did everything right by the standards of his era, and he still lost everything. Not because he was foolish, because he was trusting a system he didn't fully understand. The question isn't whether you trust your retirement system. The question is whether you understand what you're trusting. And if you can't answer that question clearly, if you can't name the assumptions, the dependencies, the failure modes, then you are in exactly the same position Harold was in October 1929, standing on the porch, coffee in hand, watching the leaves turn, seeing nothing but blue sky ahead. This is historical and educational analysis. It is not financial or investment advice. The events discussed are matters of documented record. Consult a qualified professional before making any financial decisions. If you found this analysis valuable, consider subscribing. This channel exists to study the patterns that most people only recognize in hindsight, because by the time the pattern becomes obvious, the window for preparation has already closed.